hopefully with good financial planning and budgeting and living within your means, that you'll have a surplus of disposable income. And with that, you become a saver or an investor. Now, saving to build wealth is essentially investing. It's where we can put our money into different options to help create a return on that investment. And in this chapter, we'll cover at a high level bonds, stocks, commodities, derivatives, mutual funds, index funds, and exchange traded funds. And then in the later chapters, we'll dive deeper into some of these. Really, what the goal of investing is putting your money to work. And depending on the kind of investments that you choose, there is different levels of risk and different levels of potential returns. And as your investments grow, your share also will grow with it. Bonds are a debt. The bond issuer borrows by selling a bond and promising to the buyer regular interest payments and then eventually a repayment of the principal at maturity. If a company wanted to borrow, they could go to a lender and borrow from them. But if a company wants to borrow a lot, it may be hard to find a single lender or investor. And so that's why they would use bonds and can sell it to multiple investors. Another way to think about bonds is that they are essentially IOUs. When you buy a bond, you become a lender to whoever is issuing the bond. And there are a variety of institutions or organizations that can issue bonds. The Treasury, our federal government, issues bonds. A corporation, state governments, local governments, and even foreign governments. A bond is a formal contract to repay borrowed money with interest, often referred to as a coupon, at fixed intervals. Now, the interest rate on the bond could be a fixed interest rate, or it could have a floating interest rate. With fixed interest rates, they will not change during the life of the bond or the term of the bond. Whereas a floating rate will have changes that adjust with the market rate, like the prime rate that banks charge for their most trustworthy borrowers or the target rate set by the Federal Reserve. Features other than like the principal and interest also include the issue price, which is the price you pay to buy the bond when it's first issued, the maturity date. So this is when the issuer of the bond has to pay you back. Note that bonds tend to be less risky than stocks, which often means that you won't get as high of a return as stocks would. And in terms of liquidity, because some bonds can last a while, a couple years, 10 years, even longer, that money that you have put out is locked in and you can't use it. Stocks, or also known as equity securities, are shares of ownership in a company. When you buy a share of stock, you are buying a share of the corporation and its future profits. But note that stock shares do not promise you any returns at all. You can actually lose money if the price of a stock goes down. The size of your share of the corporation is proportional to the size of your stock holding. So if a company does create a profit, some of the profit may be paid out to owners as a dividend, which is a regular payment of profit made to investors who own a company's stock, usually in cash, but sometimes it can be in the form of additional shares of stock. Note that the company may pay no dividend at all. So why do corporations do this? They issue shares to raise capital. And when shares are issued and traded in a public market, like a stock exchange, that corporation is considered publicly traded. So there are many stock exchanges in the US and around the world, but the two best known ones in the United States are the New York Stock Exchange, which was founded in 1792, and the NASDAQ, a computerized trading system that's managed by the National Association of Security Dealers. You may have heard the term commodities, which are the resources or raw materials like soybeans, cotton, wheat, which are agricultural products, or energy resources like oil, coal, natural gas, precious metals like gold, silver, copper, and even currencies like the US dollar, the yen, or the euro. Commodity trading was formalized because of the risks inherent in producing commodities, raising and harvesting agricultural products or natural resources, and the resulting volatility of commodity prices. As farming and food production became more mechanized and required a larger investment in capital, commodity producers and users wanted a way to reduce volatility by locking in prices over a longer time period. So one way to do this was through futures and forward contracts, with forwards being a form of derivatives. So this is the term for any financial instrument that's based on the future and therefore uncertain. The price of another security like a stock, a bond, a currency, or a commodity. For example, if you know that you will want to have wheat next year, you could wait until next year to buy it at the market price, which we don't know what that's going to be. Or you could buy it now and pay today's price and store the wheat for a year. Doing so would remove that uncertainty, but now you have to store that wheat. So alternatively, you could buy a futures contract for next year's wheat now and buy it at a price that's known to you. This is stated in the futures contract, but you won't take delivery of the wheat until next year. When you buy a forward contract for wheat, you're literally buying future wheat that doesn't exist yet. But by buying it now, you're avoiding any uncertainty about price that might change. And then there's something called options, which are the right, but not the obligation to buy or sell at a specific price at a specific time in the future. These are usually written on shares of stock, as well as stock indices, interest rates, and commodities. So these derivatives, like forwards, futures, and options, are really used to hedge or protect against the existing risk or to speculate on what's going to happen in the future. A mutual fund is an investment portfolio that consists of securities that an individual investor can invest in all at once without having to buy each investment individually. So think of it like a pre-packaged set of investments. So you don't have to go one by one. You just pick out the mutual fund that you want that has the nice basket of investments in there already. Mutual funds are popular because this was a way to get diverse investments and minimize your transaction costs. And mutual funds can be helpful for newer investors because they are managed by a professional portfolio manager. An index fund is a kind of mutual fund designed to mimic the performance of an index. So this is a particular collection of stocks or bonds whose performance is tracked as an indicator of the performance of an entire class or type of security. So an example would be Standard & Poor's or the S&P's 500, which is an index of the 500 largest publicly traded corporations. Mutual funds are created and managed by mutual fund companies or by brokerages or even banks. An exchange-traded fund is a fund that tracks an index or a commodity or a basket of assets. It's a kind of mutual fund that trades like a share of stock in that it's valued continuously throughout the day and trades are executed at the market price. So in earlier chapters, we talked about planning a budget plan or a savings plan. So just like with investments, you should have an investment plan. So this is known as an investment policy statement. This outlines your goals and constraints and are popular with institutional investors such as pension plans, insurance companies, or nonprofit endowments. You as an individual user, you can create your own investment policy statement because it'll help you think about the kind of planning or investing that you want to do. So the advantages of creating an investment policy for yourself is it makes you think about your goals and expectations and then adjusting them to what is possible. It gives you an active role in your investment planning, even if ultimately the specific details and implementation are left to a professional investment advisor. So you need to be able to communicate your goals, wants, and expectations so that they can find a strategy that aligns with what you want. The nice thing is your policy statement is portable, meaning like if you change advisors, you can bring that plan with you and that can continue the work that you've been putting towards in your investments. And it's also flexible. So you should be updating your investment policy statement on an annual basis. The policy statement has two parts. The first part is going to list your return objectives or goals and your risk preferences. The second part of your statement is going to list your constraints on investments. So when you're figuring out your return objectives, this means you are trying to quantify the required annual return necessary to meet your investment goals. Is it 5%? Is it 10%? You also need to identify your risk tolerance, and this is your ability and willingness to assume risk. And it's going to be based on your asset base, the time duration or your time horizon, and what are your liquidity needs. So do you need cash now or can you wait a little bit? For some folks, if you're more likely to say, hey, it's more important to me to preserve what I have than to make big gains in the market, you're considered risk averse. And your willingness to assume risk is a combination of things. It's a combination of your personality, your past experiences, good and bad, and your knowledge or awareness of how these markets work. When figuring out what your constraints are, this is trying to recognize what limitations that might impact, good or bad, the progress towards your goals. And these constraints could include, again, your liquidity needs, like what cash do you need now versus later, how much time you have in order to grow your investments, what tax obligations, if any, depending on what it is you own and how you've invested. Then there's the legal requirements that might be associated with, if it's a trust or family foundation. And then any unique circumstances are really your individual preferences, beliefs, and values. So an example of a unique circumstance could be the desire for socially responsible investments. So these are investments based on ideas about products or businesses that are socially desirable. So maybe you're big on the environment. You want to invest in companies that are working on sustainable, renewable energy, for instance. Another example of a unique circumstance might be a divestment, which is taking money out of investments. So as an investor, you may disagree with something a company does, and so you don't want to finance their activities, whether it's for political reasons, or maybe they've done something terrible to the environment, or maybe the way that they treat labor or people. It is your way of boycotting their company. Ultimately, you want to choose investments that reflect your investment policy statement. The hard part is you can't predict what's going to happen in the future. And so this is where trying to figure out ways of measuring return and risk is about learning how to read and use information that you have access to. So when we talk about returns, this could be a profit or loss on an investment. And it's usually calculated as an annual rate of return. If an investment earns 5%, for example, that means for every $100 invested, you would earn $5 a year. Now, in order to calculate the percentage return, you need to know the original value of your investment, what income you're receiving, if any, and what's the gain or loss. And to find the gain or loss, you have to take the ending value and subtract the original value. The ending value would be the value at the time you sold it. Information about current and past returns is useful because investment professionals are more concerned about the expected return on an investment. So this is how much an investment may be expected to earn in the future. So the way we do that is they'll take an average on the return the asset has generated based on historical data of what actually happened. Estimating the expected return is complicated because there's a lot of things that can affect that estimate. What's going on in the economy, in the industry, in the market. So let's talk about measuring risk. Investment risk is the idea that an investment will not perform as you expect, that the actual return will be different from the expected return. The standard deviation is the difference between the actual returns and the average returns. So we're comparing what actually happened in a particular year against what on average has been happening. And so returns with the biggest standard deviation, that means it's got a lot of variance from the average and are considered higher volatility and therefore riskier. So it's helpful to know the kinds of risks that can impact your investment. There's economic risk like inflation and unemployment and interest rates. There's industry risks. For example, like the airline industry is impacted by the price of oil. There's company risks. So think about a company and its characteristics that could affect its performance. And then there's the asset class. So these are the ways that investments are categorized by the markets that they're traded in. And then, of course, there's the market itself, so stock market performance. So if we actually take a look at how different asset classes compare, right, like stocks has a high level of risk, and the time horizon is longer term, and the potential returns are high. And I've mentioned before, bonds are not as risky, so they're moderate. Their time horizon can be medium or long, and the returns are on the moderate side as well. With cash, that's what you have on hand. That's low risk, short term, and therefore low returns. If you think about your checking and savings accounts, they give very, very, very low interest rates by keeping cash in your bank account. Now, we've already actually kind of talked about the asset classes, right? There's corporate stock or equities, bonds, the commodities and derivatives, but there's also real estate, both residential and commercial, as well as collectibles, stamps, coins, baseball cards, vintage cars, and fine art. One way to reduce risk is diversification. So this means you want to spread your risk out by having more than one kind of investments, meaning you'll have more than one kind of risk. If you've ever heard the phrase, don't put all your eggs in one basket, that is alluding to how diversification can be helpful. So you'll want to choose investments with different risk characteristics and exposures so that when maybe something bad happens in one area, you are still, covered by your other investments that are not impacted by the downturn or the risk impacts. Capital allocation is the first diversification decision. It determines the portfolio's overall exposure to risk or the proportion of your portfolio that is invested in risky assets. The second diversification decision is asset allocation. So this is where you have to decide which asset classes and therefore which risks and markets to invest in. So here's an example in a pie chart how you could divvy up where your money is sitting in different asset classes. Now, asset allocation depends on your current situation, goals, and risk tolerance. So my pie chart, say in my 20s, is going to look very different than for someone in their 60s. And then the third step in diversification is security selection. So this is choosing the individual investments within each asset class. In terms of investment strategies, capital allocation, that's here up at the top, decides the amount of overall risk, and asset allocation tries to maximize the return you can get for that amount of risk. And then security selection further diversifies within each asset class. One strategy for security selection is investing in index funds. So recall I gave that example of the S&P 500 index fund, where you're essentially investing in the 500 largest corporations in the US. By investing in an index, you are achieving the most diversification possible for that asset class without having to make individual investments. And this is essentially a passive management strategy. So again, you're using that index to diversify, but you're not making any security selection decisions. You're not picking and choosing which companies, stocks to invest in. Then the alternative to that, though, is active management. You are making security selection decisions because you think that you can outsmart the market. This works for people who do careful research and analysis. And then another strategy for asset allocation is market timing. So this is shifting the asset allocation in anticipation of economic shifts or market volatility. So this works for people who have a really good understanding of the economy, big picture, and kind of see trends of how things are going. And like, for instance, inflation or deflation, and then using that knowledge in order to make decisions on which assets you want to invest in. Personally, for me, I do a combination of passive management and market timing. So I invest in a variety of indexes. But in terms of market timing, I also pay attention to what's going on. And for instance, when I noticed interest rates were going up, I obtained a treasury bond.